Commissioner. Thank you, Commissioner Chilton, Commissioner Amalia.
I guess I'd like to follow up. Mr. Epstein raised a serious concern regarding the physical inventory is inadequate to back up short positions, and Mr. LaSalle, you touched on that a little bit. Maybe we could get Mr. Charles, Mr. O'Hagerty to comment on that, what you think the impact might be.
There's, as the slide from the gentleman who spoke earlier showed, that there's considerably greater turnover in the London market than there is in COMEX. There is a massive amount of metal that sits in London's vaults. It exceeds by some magnitude the stocks that are available in the United States by some considerable magnitude. And any shortage of physical metal that has been mentioned a couple of times during this hearing, what's tended to happen is that there hasn't been a shortage of physical metal. There's been a shortage of one type of a particular product. Physical metal is always available. If somebody wanted, 1 million ounces of gold, HSBC could supply that within 48 hours. It's no problem. But if you wanted 1 million maple leaf coins, for example, you might find that slightly more difficult to achieve. So the physical metal is always available. It's just the type of physical metal that clients actually need at the time they require it that has been the cause of some concern. Physical metal, there is a massive stock in London.
Thank you. I'd like to start by saying I do think there's a serious divide between the base metals and the precious metals in this. But the question about the LME copper stocks is, as I said, ours is a daily settlement contract, so there is no separation between the cash and the futures market. People are trading right up to tomorrow, and you see the stock movements going through the stocks. Settlement is by a warrant, and our statistics are roughly 5% of all contracts result in a warrant changing hands. But of warrants changing hands, only 5% results in metal coming in or going out of a warehouse, and yet you still see the large volumes of metal going in and out. So the worry that there isn't enough metal there to meet the trading is not how you would look at it. The trading actually reflects the available supply of physical metal in the market. And I think the figures I've tried to give about breaking down, say, by location, one of the advantages of us having warehouse locations in the 3 geographic regions is that it does illustrate why there's shortage in one and not shortage in another, and it reflects industrial demand in one and not in the other. And in copper, I think the big news in the last 8 years has been China. How much are they consuming? What is their production capacity? And I don't envy my friend Jeff's job here, because he's competing with them for supply, but he's also competing with them for the pipes he's selling, because they're turning it into pipes and selling it. And this has been an issue in the copper market since then about, is there a right price? And the answer is, that's the right price. We've had debates with fabricators for a long time, because one of the issues in the copper market compared to, say, some of the other base metals markets is there is more of a splitting between the producers, as in those who produce copper, and those who fabricate it. Up until 2002, it was more common for fabrication to be the value-added business and therefore separated out. And the traditions in the market are that you pay for your copper on the nail when you buy it, and yet you sell your pipes on 30 days credit, which when prices double up, it's not a great business model. But our role in all of this is to discover the price. And are our mechanisms designed to make that a fair discovery of the price, or does it allow it to be a manipulated discovery of the price is my daily job. And I think that supply of copper is not one of the issues. And I think we've put a lot of work over the last 100 and something years to try and learn from the various mistakes in the market over the years. And what we've ended up with is, I think, as good as it gets. Thank you.
Mr. Epstein, would you want to? I used you as an example. You're free to respond.
Thank you. The calendar roll in silver, it's typically, like right now, the May-July roll is typically trading at about 2 cents. That's more or less the cost to store the silver. And it always trades more or less 2 cents. When we were in the situation where people were withdrawing physical silver from COMEX, it was trading 10 cents the other direction. It was a massive move. And the perception, and that doesn't happen by a few contracts. If you look at the market in the roll, You know, it's often 10 or 20 or even 30 or 40,000 contracts up, a tenth of a penny wide. So for it to move 12 full cents, and I'm not talking about at expiration moment, I'm talking about during the 30 days of expiration, something significant was taking place, and the issue was that the draining of physical metals in Chicago or from COMEX was actually an easier way to get metal than any other place on the planet. That shouldn't happen in the futures markets.
Thank you, Commissioner May. If I'm going to allow another round, because I had at least a question, but if you can work with me to keep your answers really short. So, Mr. Haggerty, I was just curious whether you're familiar with the FSA's, what they call position management approach, where they said, and this was in a public document in December, I was there last week and talked to them about it, that they work with the exchanges, not just your exchange, in what they call position management. It's not hard limits, but if one particular trader gets large or outsized or concentrated on the market, they sort of have a dialogue with you about it.
Yes, I'm afraid this is not me talking about us, because our market has the daily delivery, and therefore the lending guidance is that tool. But on the physically settled markets in the UK, they tend to be monthly or bi-monthly contracts. So partly because there's an issue about the commodities deteriorate over time. What they have is historic records of available supply in the settlement month. And all of these tools, including our lending guidance, are to guard against settlement squeezes. So what they're trying to make sure is there's enough supply to meet the spot month deliveries. And what they have is they get information from the position holders, and once they reach certain levels, I think they're a bit like the things the CME run, is they trigger potential action. And the rules of the exchange do allow them to force positions to be closed out. So that's how, in effect, they actively manage the positions leading up to delivery.
I take your answer as you're familiar with their position management regime, though it's used on the other exchanges, and that they use it in a way to, as you say, to protect against squeezes in the delivery month.
Yes.
I thank you. I just had a quick question for Mr. LaSala. I noticed that the gold and silver markets currently have identical accountability levels, and the gold open interest, is roughly 5 times the silver account. And I know they're historic numbers, but was interested in why.
I think you hit it, Commissioner, Mr. Chairman, I should say, that it's just simply a historical matter. They were down. Those are very, very low, and we found that they give us, relative to the open interest, lots of latitude. That plays contrary to the point.
So it's just historic.
Historic.
My last question, because I'm running out of time.
Yep.
For Mr. LaSala. You talked a lot with fellow commissioners about how often you talk to people over the accountability levels, but I'm just curious, how often do you talk to the large, there's, from the Mr. Sherrod's thing, there's the top 4 have very concentrated positions. Mm-hmm. How often do you talk to those particular traders that have the very large concentrated positions?
I'd say to you, where appropriate and where necessary, and I will share with you.
Where necessary, how often is that? Is that daily? Is it weekly?
No, it's not. It's not daily. If we have checked with them some months ago about the position, and we know their business, so to speak, XYZ
Right.
Merchant Bank has typically, through queries we've made with them, maintained short positions, and
Then you leave it alone.
we would leave it
Okay.
alone.
Mr. Charles, just quickly, on the physical long side, you say you're short futures and long cash.
Mm-hmm.
Does that just stay in a vault, or do people actually deliver? Do HSBC deliver out and deliver in? Are you dealing in that?
Part of the clearing system in London is regular deliveries in and deliveries out. Typically, we maintain considerable inventory. The London market is a primary settlement location for physical markets globally. So producers, for example, would deliver metal into the vaults for credit to their account, and consumers will take metal out of the vaults. the metal that we tend to arbitrage against the futures market will be kept in a vault.
Yeah, I think it would be helpful for this discussion, not only for the commission, but for the public to understand that, because there's been a lot of focus on the large concentrated shorts. And as you've described it, at least for HSBC, you have this long position there, and just whatever the business model is, to have a little bit more transparency, I think would be helpful to understand that. Oh, Mr. LaSala, because I don't.
Thank you. Mr. Chairman, if I could just add, to follow up the point you made earlier, we recently conducted a review of the large shorts in gold and silver, and I'd certainly be happy to share those results with the DMO folks at the conclusion of the meeting.
That would be
I think
terrific.
the
Thank
results
you.
will be comparable to what we've seen in the past.
Thank you, Commissioner Dunn.
Quick demotion there, Mr. Chairman.
No, not at all.
I think that I understand on the precious metal, on gold to a large part, and to silver, that when times get rough, the dollar gets high, people say, well, all right, we want to hold that as a hedge a bit, and people get gold and they keep it. They don't. It's not being utilized. But I have a real concern on the copper area. And Mr. Burkhart, for you people in your business, you're looking not only at copper market as price discovery, but also to hedge, so that you can, when you're going to do a job and somebody comes in, wants to know how much copper they're going to have on a building, or the automobile industry says this is how much copper we need, you have to be able to hedge on that. And I am concerned about all the externalities out there when I see there's a big strike in the largest copper mine in Mexico, and then I see the economy go down, and then why are the prices still up here? So if you could kind of talk a little bit about that concern of yours, and Mr. O'Hagerty, if you could respond, I would appreciate that.
Certainly, for our industry, copper is it's the raw material for our industry, and so we need a couple things. First, we need markets for it, and for that to happen, it has to be cost effective. We've already seen where we've lost markets, because of the price of copper, because of substitution. So it needs to be price effective or cost effective. What we've seen is, if you go back, copper was traded in a range of 70 cents to $1.70. And that was typically, based on the cost was maybe 80 cents, 90 cents. When copper was in a surplus, it went below. When it was in a shortage, it went well above, okay? Not all that much has changed dramatically. But now what we see in our business is copper goes in a range of $1.40 to $4 in a matter of a relatively short period of time. So number one, we don't feel that's reflective of fundamentals and cost. The fundamentals as far as demand haven't changed as far as consumption. If you look at warehouse stocks, I pointed out earlier, the market's in a surplus. Why is the price doubling when the market is in a surplus? So clearly we feel that the market, which is so critical, for our industry, because we use it to establish prices and to manage our risk, okay? But we feel it's gotten away from the fundamentals. We're still using it for price discovery. We still use it for risk, okay? We've applied for hedge exemptions in the past because we needed it to run our business, all right? But what we'd like to see is a reduction in speculation so that the price is now reflective of costs and fundamentals. It's interesting, most of you heard of I'm sure everyone heard of the large earthquake in Chile, that occurred, and it was a real, catastrophe down there. I think the price moved 7 cents that day. It moves less on an event of that magnitude than it does when one large player comes into the market, and we don't feel that's correct.
Mr. O'Hagerty, if you could respond, Mr. LaSala, I'd like you to respond as well.
Okay, I actually have given you some slides. These are 2009 figures because they cover the whole year. Slide 5 gives the capacity of listed brands. This isn't just total capacity, but this is listed brands. And according to those figures, it's 14.5 million tons was the capacity. And then you look at the stocks. Slide 7 gives you the stocks in LME warehouses during that period. And again, I just try to point out that the net figure compared to the gross figure in and out, this is not metal that people are taking and keeping as an investment. This is metal going in and out. Now, our market is run on the assumption that it is the delivery of last resort and the supply of last resort. I think when Jeff was talking about his risk, he doesn't use markets to source his metal. He needs it direct from the producer. If that pricing is against an exchange contract, and although the COMEX provides a US price discovery, because of our 3 geographic regions, we provide a global price discovery, and most of the trade outside the US, and even the trade into China, is basis the LME price. So the volume you see trading on the LME is price risk trading, not metal trading. Just-in-time metal, absolutely. But the most liquid contract on our exchange is 3-month contract. It's a rolling 3 months. So every day you're trading for 3 months forward. That is price risk. It is not just-in-time metal.
Mr. Dunn, to follow the comments of Mr. Haggerty.
Just trying to help, it's Commissioner Dunn.
Did I say, I'm sorry. Commissioner Dunn, to follow Mr. Haggerty's comments, would agree that on COMEX in the copper, we've seen more movements in that in and out than the other metals. So it's been utilized by commercials to draw inventory more than others. It's been the one contract also that we've made the most adjustments to in the context of the spot month limits. Back in 2006, the available metal was down in less than 100 contracts worth of material. We had a number of initiatives making adjustments to the limits, margins, and the like. Further, to note Mr. Epstein's point about volatility in the market. International Copper Study Group in 2009 found that there was a deficit of 140,000 metric tons in the first half of 2009, and then there's a half a million ton surplus in the second half. And the point I'm simply raising here is that these dynamics, this is not one smooth playing surface. There are supply deficits, supply surpluses that the market is factoring in that will in fact lead to, I think, that volatility that's being noted. I don't see the investment, I think that may have been the genesis of your question, in copper the same way as you do in more the precious metals, gold and silver. Thank you.
Thank you, Commissioner Dunn. Commissioner Summers? No. Commissioner Chilton?
I wanted to get back briefly to exemption, and I appreciate Mr. Charles' response earlier. I will note, and I won't give a name, but representatives of other banks have told me that they actually could, not that it would be easy, but they could separate their own book from those of their customers, and therefore they didn't have a problem with, at least one bank, they didn't have a problem with saying that they wouldn't use the exemption from any position limits for their own trading, for their own speculative trading. That's sort of an important concept to me. I think it's maybe where we went awry on some other issues outside of our markets. So I think, one, we should approve these exemptions. I'm not suggesting that the exchanges have done a poor job of it, but I think it's a government responsibility, and I think we should do it. I think it's our job. We should step up to the plate. Two, I think they should be, to the extent that we can craft one, make it targeted for legitimate business purposes and not for their own book. And I think it needs to be verifiable, that we check on it all the time. And then finally, and this is in our energy proposal also, I think it should be transparent. I find it amazing that currently under our rules and regs that we can't tell the public who has an exemption or even how many there are. So if we've learned anything, it seems that more transparency, the better. Mr. O'Hagerty, I'm curious about the, you've got a massive supply in London in metals, but are there multiple claims against some of those metals?
It's not in London. It's at the areas of net consumption. We try and have our locations in areas of net consumption.
Okay.
The metal is always owned by one person at any point in time, and so there's never any argument about who owns it. The concept of futures trading is that if I'm going to deliver tomorrow, I better have metal, or I'll pay for it. If I'm trading out to 5 years, the metal I'll worry about it closer to the time, and therefore you can't really tie up the futures contracts with the available supply of metal, except that there is a continuum.
When you get to the spot month.
Well, basically, you start out at 5 years being price discovery, trading price risk, and both consumers and producers do that. A day out is physically trading metal. Now, at what point in time it changes between the two is actually almost impossible to separate out.
Mm-hmm. I think on average, maybe Mr. Sherrod can give me a number here, but I think on average the futures to physical is 10 times greater. 10 times greater the futures. Do we happen to know what it is on silver or gold off the top of your head? No. Well, anybody happen to know that off the top of your head? Okay.
Well, can I help you there?
Yeah, please.
The convention in the base metal markets is for producers and consumers to buy and sell basis a future price. So they will sell for in 6 months delivery basis what will then be the LME price. If they both hedge and if they've agreed to trade 100 tons, you get double the amount hedged on the exchange to put the hedge on, and then double the amount to take the hedge off again. So that's 4 times.
Okay. Thank you. I know my time's about to expire. I'll go real quick. Mr. Epstein, most of the large price moves that we see in silver and gold tends to take place when COMEX is open. Yet, as Mr. Sherrod talked, there are plenty of other venues for trading of metals around the world. But COMEX seems to be where the price is set. Do you have a thought as to why that is?
The futures markets in the United States are great. You've got the counterparty risk managed via the clearing firms and the exchanges. You've got fair price discovery. The CME does a great job of providing a FIFO market right there all the time. There's no reason that price discovery wouldn't take place at COMEX. The fact that it has to have a reality check against physical trading as you get close to spot month, absolutely. But in the gold and silver particularly, more so than perhaps quite copper, I mean, all the trading takes place in spot month, and then on a single day it switches to the next month. And the trading that's taking place in July or Separdis right now doesn't take place in July Separdis. It takes place in the May contract because the rolls are so clear and specific. So everything takes place in a single month in the precious metals.
Thank you.
Thank you, Commissioner Chilton. Commissioner Amaya.
Thank you. I'd like to congratulate Mr. Burkhart for his coming up with an alternative strategy. And in your testimony, you raised the proposal that significantly higher margin requirements for investment funds would be a more effective solution. In light of the global nature of these markets, could we get everybody to comment on the impact that might have on trading, liquidity, and pricing? Maybe Mr. Burkhart might want to explain his proposal, and then everybody comment on it.
Sure. Just to elaborate a little more, I think some of the discussions we've had already show that while we have had position limits, question how effective they've been. Also, it's my view that a lot of those position limits have really been to prevent spot squeezes in a commodity. And that's really not what we're talking about here, 1 or 2 players trying to squeeze, the spot month in a commodity. More, it's a large group of speculators coming into the market, not necessarily in spot positions. And the concern is if we put position limits on, that more and more speculators could continue to come into the market and become a higher percentage of the market overall, okay? As long as they don't hit those position limits, the speculation, the percent could increase overall in the market. And that's why the alternative, many of the markets have margins of 5 to 7%, which I feel is very low and certainly invites a lot of volume as people come in with dollars. They can trade a large number of contracts. So that's the reason behind it.
So your proposal is to raise the margin,
Correct.
and then maybe we can get everybody to comment on that.
I thought it was kind of interesting when you said it, but the reality is that the large players aren't capital constrained. If there's a 5 or 7% margin or 10 or 12% margin, I mean, right now the margin in silver is, I guess, about 7, 8%. If I had to post 100% margin, I'd still do all the same trading. So it's not, and for the big people that are taking positions, large financial institutions and so forth, they can't take the risk of controlling, an asset without having the reality that they could have a margin call the next morning. So I don't think raising the margin is going to substantially affect any of the trading. Reducing the size of the position limits, if that brought in a more robust marketplace through a more participation, I think you'd wind up with fair price discovery through that mechanism.
I think my only comment would be that, as I made clear in my statement, that the markets are very, very global. There's a lot of markets around the world. The US is just one market of many. If you disadvantage participants in the markets in the US alone, then the potential is that customers will just take their business elsewhere.
Commissioner O'Malley, I'd have to respectfully not support Mr. Burkett's recommendation. That being, our methodology in the futures industry for setting margins has been in response to volatility, price movements. It sounds here like we're going to use somehow margins to, in effect, control it. It to me is the opposite of what we're trying to achieve. Margins are in response to when volatility increases, we raise margins as appropriately needed. Thank you.
Interesting. I think the point's being made so far that margin is a credit risk management tool, and therefore once you start using a tool for different reasons, you start introducing unintended consequences, and there are various issues in that. Trading is still all about buying it for and selling it for more than you bought it for, and therefore if you increase the costs of purchase, well then somebody still has to sell it for more. Buying is driven by those who think they can sell it for more. And so I think it introduces an added factor. Whether it changes the fundamentals of perception of supply and demand, I'm not so sure. In the same way, I think ultimately position limits and what we do, our lending guidance, are effective tools for settlement squeezes. Whether they're effective tools for managing a price, and this is a big debate around the world. UNCTAD had a conference, regularly has conferences discussing the role of markets as price discovery and creating proper price discovery for producers, farmers, and the rest. But whether you can manage the price, I think, it always drifts into it. And I think that's where part of the difficulty is. If you can point to a mechanism in the exchange that is failing, is there market failure? That's a useful way of working out what's going on. If what you're just saying is you don't like high prices, that's tricky because for the fabricators, copper prices at the moment might be a nuisance. But up till 2002, it was a real problem for the producers. And there was massive underinvestment in copper production for that same reason. It's a two-sided market. High prices are good news for one person who produces it, and bad news for buyers, and vice versa.
Commissioner O'Malley, thank you. I think Commissioner Dunn has a couple more questions. I don't know if anybody else does. I just wanted to also mention something that when hear you all talk about price discovery markets, which I think is fabulous, and I guess I can't lose an opportunity to say that's what at least this commissioner wants to bring to the over-the-counter derivatives marketplace. When I hear Mr. Epstein talk about bringing market makers in and having real-time, even electronic feeds to a market to see, even if it's co-located, I think that would be an advancement in these right now opaque derivatives markets. But I'm going to turn to Commissioner Dunn to ask his follow-up questions.
Well, let me associate myself with your comments on over-the-counter, not Mr. Dunn. And I wholeheartedly agree with the chairman on that, and I think it's extremely important that there not be a cutout exemption by Congress for end users. That I would prefer that Congress give us the latitude of providing exemptions for those we think deserve an exemption on those end users. That said, let me Mr. Lasala, if you couldn't tell from the tone of my questions with DMO, I think that we're just entirely too loosey-goosey on accountability level. That loosey-goosey, that's a regulatory term that we use here. But would you, first of all, how do you go about setting accountability levels? What type of impact or input does the industry have in setting those levels? And would you be opposed to the codification of working with DMO when someone exceeds accountability levels so that we at the Commission know that somebody is taking a look at it and there is positive action being taken when somebody steps over those accountability levels? Mr. O'Hagerty, for you, if you can think about this for a second while he responds, I'm intrigued with the lending guidance that you develop. And I guess 98, 99, you put together a paper, The Way Forward, and I'd like to understand the industry involvement in that and how you come up with those lending guidelines. So, Mr. Lasala.
Commissioner Dunn, insofar as the accountability levels, I think I may have mentioned earlier that the key focus, as they are not in the front month and there's more distant months, has really been one of concentration. In regard to your question about have we worked with industry, not particularly solicited, they're exacting thoughts about it, but I think by virtue of the fact that we have reached out to players over time and to the effect of asking them not to increase when they hit a certain percentage or to decrease, I think that the trading community has got a pretty good idea of where those sensitivity points are. We do not make them, we do not state them formally, and every market situation is different. I believe that the ability to have them flexible, quite frankly, is advantageous. And I'll just give you an example. As you start making them more rigid, they start more and more resembling limits that I, just quite frankly, think will lead to, for some entities will look at it as a nuisance and look for alternatives. Some of them will just look at it as a barrier to conducting business. Some in more tight markets, you might look at a percentage of X that someone attains it and you're more sensitive to it. Under different market conditions, it might be a little bit more than X. Flexibility is important, and I think we've done an admirable job of monitoring these markets and not allowing excessive concentrations to adversely affect them. That stated, to your point of would I be open to having discussions with DMO? We'd certainly be open to having that kind of a discussion. We've certainly, whether it be in the metals contracts or in the energies contracts, had discussions with DMO in particular market circumstances to have a more global one to talk about our ideas about where those sensitive points are. Would certainly be willing to have that discussion, but I say that with the caveat that I still ultimately would value having the discretion at the exchange level, because I think we are just quite frankly closest to these markets, and that by no means is a shot at the Division of Market Oversight in any way, shape, or form.
Your answer then was on should we codify what we do at a point in time when someone exceeds accountability levels, and is that you think it would be all right, but you don't necessarily think it's a good idea.
I would say that I'm not sure if it's a good idea. That's right.
Mr. O'Hanry.
Commissioner, thank you. Yes, the lending guidance came after what was no secret at the time in '96, a settlement squeeze on the exchange that had gone on for a while and was very dangerous. Two things came out of that. One was the exchange realized that it needed much better visibility on control of LME warrants. They are the currency for settling LME contracts. And so one of the things covered in the way forward was the available information to the exchange. So today, electronics have helped. We get electronic reports that allow us by 9 o'clock have a total picture of the market as of close of business yesterday. And the second point is once you have the information, what do you do with it? And the lending guidance was built on the previous tool we had, which was a backwardation limit. In other words, imposing a limit to the price for trading Tom Next is in effect how you deal with the settlement squeeze. And the consultation that went on was should there be position limits? Should there be fixed backwardation limits that apply to the whole market? Should they be on a percentage basis? Should there be a fixed amount basis? And there are pluses and minuses in all of those areas. One issue about position limits, fixed ones, is that the available supply fluctuates depending on the cycle in the market. Similarly, the amount of money you talk about as a percentage of the cash price fluctuates. And so what we've ended up with was the lending guidance, which is a more refined tool now than it was when it first came in '98, and that's why I've submitted a notice we did in 2005 that talks you through how it works, because the principle is straightforward. Somebody with a dominant position has to lend into the market, in other words, sell Tom Next at predetermined rates. But like most things, the details get complicated for those who actually do it day by day, and that's what the document goes into. We, in effect, treat 90% as total control of our market, and therefore anyone who has a 90% on our calculation, it's not 90% of the warrants, it's 90% of the warrants and entitlement to pick them up in the next 2 days. In other words, your net long positions over a 3-day period in effect. So that's why it's possible to have a dominant position of well over 100%. Anything over 90 is treated as control, and therefore you have to lend at level. You just have to give it away for a day. In practice, what we've discovered is that the 50 to 80% bracket rarely has much effect on the market. 80 to 90 starts showing an effect, and this is why the backwardation is tightened on that by us. And 90 we treat as in effect total control. Is the advantage of it as a tool, it is open and out there and a legitimate expectation on both sides of the market. The shorts and the longs know how it works. And in the last 10 years of its operation, we have found that the role of concentration of positions in warrants and the settlement has stopped being the tail wagging the dog in our market. What drives our market is the 3-month price. That's 3 months forward. Again, it takes a while to get your head around it, but it's a rolling 3 months, so that there's no backwardation or contango in that price. Today it's 3 months, tomorrow it'll be 3 months from tomorrow. And therefore it is a pure commodity-related price. The cash to 3 backwardation or contango, it's all in contango at the moment, is what happens if you've left it a bit late. 3 months is a reasonable amount of time in the metals industry to plan. Less than 3 months is you're now just-in-time buying. And therefore, there are 2 measures going on. What's the 3-month price telling you? In other words, what's the perception of the commodity value? What's the cash to 3 price telling you? Is there a shortage of supply?
Thank you, Commissioner Dunn. Is it on this point that's all right, Mr. Burkhart?
Could just share one point. He mentioned, that currently everything is in contango. Contango markets occur generally when you have a surplus, which is another indication why we feel that the prices right now aren't reflecting fundamentals.
Thank you. I want to thank our first panel. It's been very helpful to the Commission and in our deliberations. I polled the commissioners just a short while ago, and I just want to make sure if we didn't take a 10-minute break, whether. All right, so if we can invite our next panel up if they're here. Again, I want to thank our panelists, and it'll probably take 2 or 3 minutes just to do so.